Hello friends, myself Jagruti Lade. Today I am going to explain about the fixed income security. The fixed income security is usually known as a bond and that instrument that represent a loan made by the investors to borrower. When investors purchase a fixed income security, they are essentially lending money to issuer in exchange for the periodic interest payment and the return of a principal amount and the maturity. These securities play a very crucial role in a capital market and provide a means for both government and corporation to raise funds. Here are some key components of the fixed income security. First, principal or face value. This is amount by the issuer and that is returned to the bondholder when the bond is matched. Next is the interest payment. Issuer pay periodic interest known as a coupon. The bondholder, the coupon rate is expressed as a percentage of the bond's face value. Interest payments are typically made semi-annually. Then maturity. Date is when the bond reaches the end of it and issuer is obligated to repay the principal to the bondholder. Maturity date range from few months or several decades. Then coupon rate. The coupon rate is a fixed annual income rate paid on the face value of the bond. It determines the amount of the interest and the bondholder receives throughout the bond life. Then yield. Yield represents the effective rate of the return on the bond and take into account both coupon payment and any coupon capital gain or losses. Yield can fluctuate based on the changes in the market condition and interest rate. Next, credit rating. Bonds assigned to credit rating by credit rating agencies and reflecting the issuer's creditworthiness. High-rated bonds are considered lower risk, while the lower-rated may offer higher, but come with the increased credit risk. Then market price. The market price is a fixed income security can fluctuate based on the changes in the interest rate, market conditions and some issuers' creditworthiness. Bond price move universally to interest rate when the rate is right. Bond price tends to fall and vice versa. Then types of a fixed security income. These are various types of fixed security income securities, that is including government bond, municipal bond, corporate bonds, mortgage back-end securities, treasury inflation protect securities, etc. Then callable and non-callable. Callable bonds gives the issuer the option to redeem the bonds before maturity. Non-callable bonds cannot be redeemed by the issuer before maturity. Next, objectives of the fixed income security. Steady income stream. One of the primary objectives is to provide the investor with the regular and predictable income stream through the periodic interest payment. This is the particularly attractive to income seeking investors such as the retirees. Then preservation of a capital. Fixed income aims to preserve the investor's capital, providing a return on the principal amount at a maturity. This makes the relatively lower risk investment compared to equities. Diversification. Investors use fixed income security to diversify their investment portfolios. The stability and income generated by these securities can be offset the volatility of riskier assets, contributing the balanced portfolio. Risk management. Fixed income securities help to manage the interest rate by offering fixed interest payment. This is a predictability allowed to investors to plan and manage their cash flows more effectively. Next, portfolio security. Including income security, portfolio can be contribute overall stability, while the equity makers may experience the fluctuations in fixed income investment provide a buffer against the market volatility. Then safety and security. Government high quality corporate bonds are a high quality corporate bond considered the safe haven investment, providing a security base for investors to park their funds. The safety especially appealing during the time of economic uncertainty. Then risk in fixed income, that is the interest rate. Fixed income securities are sensitive to changes in interest rate. When the interest rate rise, marketing bonds tends to fall, impacting their potential real resale value for investors who may need to sell before maturity. Inflation security. Fixed income security may be vulnerable to inflation risk. Credit risk. While high quality bond issuer government and financially stable corporations are considered low risk, there is a still right to default lower rated or junk liquidity risk. Some fixed income securities, especially those who with a lower trading volume, may face liquidity challenges. Reinvestment risk. When the interest rate decline, bondholders may face the reinvestment risk where existing bond mature and they must proceed at a lower interest rates. Then call risk. Callable bonds give the issuer the option to redeem the bonds before maturity, which can lead to the call risk. Interest rate decline, issuers may choose call and refinance the at lower rate, leaving investors with a less attractive reinvestment option. Then market price volatility. The market price of a fixed income security can be subject to volatility influenced by the such factors: economic condition, geopolitical events, and changes in investor sentiment. Then inherent opportunity cost. While the fixed income security provides a stability income, they may have a lower return compared to riskier investment, resulting the opportunity cost for the investor seeking higher potential returns. Next, types of a fixed income security. Bonds. Bonds are the debt security issued by the government or municipalities or corporation to raise the capital. They typically pay the periodic interest bondholder and return the principal at a maturity. Next, treasury security. Issued by the government, treasury security are the considered one of the safest fixed income investment. They include treasury bill, treasury notes, treasury bonds, etc. Then municipal bonds. Municipal bonds are issued by state or local government to fund public projects like infrastructure development. Then corporate bond. Corporate issue bond to raise the capital for a business operations. Corporate bond offer higher yield than a government bond, but with a higher credit risk. Then zero coupon bond. Zero coupon bond do not pay the periodic interest but are sold at a discount to face value. Then convertible bond. Convertible bond allows bondholders to convert their bonds into the predetermined number or common shares of the issuing company. Then preferred stock. While not traditional bonds, preferred a stock share characteristic the fixed income security. The asset backend security. ABS are backed by pool or financial assets such as a mortgage, auto loan or credit card receivable. Then government agency security. Issued by government sponsored entities like Fannie Mae and Freddie Mac. These securities are backed by US government. Include the mortgage backend security or carry credit risk. Thank you.